Welcome back. We've been discussing the monetary policy and the fifth consecutive rate cut. Pranjul Bhandari, Lakshmi, Iyer, Amandeep, Chopra and Rajiv Anand and SBI's Arijit Basu joining us shortly. Well, Pranjul, I want to ask you the situation on inflation. I've been speaking to some NSSO people, and apparently the collection of inflation data passed on from the post office to the NSSO sometime last November, and that's when the NSSO realized that they've not been collecting the data properly, and you saw the sharp fall in food inflation. So there are people who believe there is going to be a very sharp spike in inflation. Is it possible that we are going to see an awkward, maybe 4% inflation in the first quarter?
Well, look, I'm not penciling that in. I think one thing that was clear in today's policy was the fact that rains have turned out to be normal. After all, Kharif production is likely to be as good as last year. And generally, if you look at product-wise inflation, things are in control right now. Core inflation is already very low. I don't think food inflation can really spoil the math at this point. Towards the second half of the year, I do think inflation will inch up. Perhaps for a month or so, it could even touch 4%, but I don't think it will sustain there at this point, even because of statistical reasons. Okay. So overall, inflation is not in the top few of my list of things I worry about at this point.
Okay. Well, Amandeep, what's your take on, if there is this borrowing program announced, 20,000 crore or 50,000 crore, maybe let's take the benign scene, 20,000. What happens to yields in the first quarter? Do you think where does it trough out for the government, and where does it trough out for a AAA corporate?
Latha, I think our sense is that any incremental borrowing is possibly going to be more in the fourth quarter. So I think in the current quarter, the government is more or less going to stick to the current calendar. So we're not looking at any negative surprises on supply. I think the finer rebalancing will actually take place in the Jan to March quarter. I think that's when they would have possibly exhausted all other avenues to mitigate, the additional borrowing. And that's possibly when, they will actually have to now factor in the net deficit and then look to possibly issue. Now, like I mentioned earlier in an earlier interview with you, there are certain avenues that the government can still utilize to mitigate the impact of the, the slippage.
Like FCI.
Now, we just need to see how much of it can actually be met out of different resources. Okay. You're right. Okay. And clearly, there is a potential, interim dividend expectation from RBI as well. Okay. And that typically does happen before, the budget.
Yeah, well, the Jalan committee said no.
You do have some tools which the government can deploy.
Okay. Well, very quick.
We're not so sure on that, I guess.
Okay.
It's too early.
Okay. Well, there may be an interim dividend. Maybe the Jalan committee said no, but it could still be there. Lakshmi, Iyer, what is your sense about the real estate sector and the housing finance companies? Are we headed for something very bad over there? Or do you think this liquidity or some other package will work? How are we going to continue to live with this pain?
See, the fact remains that barring few or very hand-picked HFCs, which is housing finance companies, most of them are not getting the desired amount of money, number one. Number two is real estate sector by its nature is A, chunky, second, illiquid. So when you have exposures like this, specifically I'm talking about the developer book of the housing finance companies, incrementally the cost of borrowing obviously has seen a gradual rise. There has to be something specific which has to be done to address the needs for this sector, failing which it will be very difficult. As I mentioned to you, there will be only those couple of hand-picked names which will continue to be recipients of money, more money and most money, and of course cheaper money.
Okay, I'm preserving the toughest maybe or the best question for Rajiv. Rajiv, what is the likely bad loan tail that is left because of housing finance companies and realty? And secondly, are we going to see a single-digit loan growth only in the current year?
I think if you look at the, I'll take the second one, it's a bit easier. If you look at the loan growth, I think we are somewhere in the vicinity of between 10 to 11%. And I think that is also driving lower growth in deposits as well, because I think unless you get credit going, you get the money multiplier going, I think deposit growth it will continue to be anemic, and therefore the ability of banks to reduce deposit rates and therefore reduce rates and in a much more aggressive fashion is constrained. And so therefore even if you look at the growth there, it's driven by one, the retail side, which is in the vicinity of 15%. I don't see that coming off anytime soon. Corporate loans to the industry is about 3-4%. I don't see that going up in any material fashion anytime soon. And I think services sector is about 10-11%, which includes the NBFCs as well. So therefore, in that sense, I mean, we are on the cusp of somewhere between 9-11% growth. It's going to be very difficult for that number to go up, despite what the government has done and despite what the RBI has done and will continue to do as we go forward.
Out of time, but NPA, how much worse does it get?
I think much of the recognition as far as NPAs I think has been done.
Another 1 lakh crore, 2 lakh crore.
Very difficult to call, Latha, but I think it's clear that there is stress in the system, but I don't believe that it is certainly anywhere as bad as the previous cycle.
Okay, of course not. I mean, one hopes it's not another 8 lakh crore. Mr. Basu, how much can you cut deposit rates? Let us assume there is a 25 basis in December, and let us assume there is a 15 or a 25 in February. How much can you cut deposit rates? FD, say 1 year FD and savings rate.
So we need to FD, as you know, that it is linked to our ability to the requirement of funds that the bank has.
Yes.
So we would be able to cut rates when the liquidity is comfortable, number one. Number two, up to a point we can do that, but we also need to be sensitive to retaining our deposit franchise. So as in case of savings bank, for example, for the high value accounts, we have already cut. And as I was sharing with you, I think our NIMs are protected largely because of that.
No, for low value.
But FDs, it is very difficult to predict in advance how much we'll be able to go, because it all also depends on how the market moves in terms of interest rates going down. There is still some scope. I won't say that it is over. But these are the two major factors which will determine whether we will cut or not. One is how much of funds we need, that is depending on our credit growth, etc. And second is up to which point we will go, keeping in mind that FDs are part of the entire deposit franchise.
All right. Well, completely out of time, though not out of questions. Arijit Basu, Lakshmi, Iyer, Amandeep, Rajiv Anand and Pranjul Bhandari, thank you very much for joining and enriching our understanding of the economy, the financial markets and the banking system. I think the key takeaway, you're not going to get very good credit growth. It's at best going to be 10%. And really, there is a trust deficit. So it is simply not getting passed on in the form of cheaper capital to even AAA companies, and much less to AA, A, and not at all to companies that don't figure in that A category. The limits of monetary policy is very clearly seen. We have to look for other tricks to revive the economy. That's it on this edition of Economics.